This week, the FOMC is meeting and announcing their rate decision. We'll see what they do. We'll give a preview for our audience with Professor Hanke, Steve Hanke, professor of applied economics at Johns Hopkins University, globally renowned economist who's an expert on monetary policy and currency reform and just the economy overall. Welcome back to the show, Professor Hanke. Good to see you as always.
Yeah, great to see you, David.
We had a great session last couple of weeks ago with Art Laffer. People can check that out down the link below. We discussed in detail your views on inflation, the economy, your economic outlook. So let's talk about what the Fed may do this week. So the U.S. added a better than expected 272,000 jobs in May. Unemployment rate is still edging up towards 4%. So non-farm payrolls expanded by $272,000 people rather for the month, up from 165,000 people in April. So well ahead of the Dow Jones consensus estimate for 190,000. Do you follow these payrolls numbers on a weekly basis? Do they mean? I mean, is it building a trend of an improving labor market, Professor?
Well, yeah, I do because that's one thing that the Fed watches for sure, and that's always been the case. This is really nothing new. So the one thing we know they don't follow is the money supply. They claim that changes in the money supply have very little effect on the economy or inflation one way or another, which of course is wrong. They've deep six the quantity theory of money and the idea that you should be watching the money supply, and that the money supply does, through the transmission mechanism, ultimately affect asset prices, economic activity, and inflation. But they do look at the labor market closely, and so I do follow it, and I think we are seeing a little weakness in the market. If you stack up all of the labor market data that have come in the last couple of months, I think it's softening, not strengthening. You mentioned the last piece of data that came out. It was quite a bit stronger than the consensus, but the overall picture is gradual weakening, and one thing that you mentioned is that the unemployment rate has gone up to 4%, and I think it will continue to go up, and as it does, the change in the inflation rate is something that does give us some indicator of where the economy is going in the future. In other words, the absolute level is low, and it's going to remain low. Even if it goes up, it's going to still be appear to be a fairly healthy number. But it's a change where you're going from, and how fast you're going from the low to the increases that count. And it's now, if it goes up much more than it's this 4% level, David, in the next few months, we'll get a pretty good signal that we've got trouble in the economy. That really confirms what I already think. I think we do have trouble in the economy and a slowdown baked in the cake, because we've had this contraction in the money supply going on really since March of 2022. So contract the money supply, and nominal GDP, that's the real component plus the inflation, that's nominal GDP, it will ultimately start slowing down. The trick, David, is that there are long and variable lags between changes in the money supply and changes in nominal GDP. And so you can't put your, it's very difficult to just put your finger. You say, well, what month is the inflation going to go up, or what month is the inflation going to go down, or the economic activity? That's hard to do because these lags are long and variable.
Well, we're starting to see actually outright deflation in some products and stores. So Amazon, Walgreens, Target, big box stores have been cutting prices on their grocery items. Amazon by up to 30% on some of their grocery items online and in their brick and mortar stores. So it seems like they're no longer able to pass on these cost pressures to consumers, and there's a bit of a price war going on. That broadly supports your thesis, right? Are we going to expect deflation now? And forget disinflation. Deflation
Well,
seems to be the point of
I
the.
well that we could get that deflation being negative changes in the price level.
Yeah.
We right now are kind of plateaued at a kind of a constant rate for the last 4 months, but we're in a disinflation mode where it's coming down. John Greenwood and I think that by the end of this year it'll be between the CPI, the headline CPI, will be between 2.5% and 3%, but it could get down below 2% in 2025.
By the way, Professor, the
That still would be just disinflation, not deflation.
right, right. If we were to, I mean, I'm not saying we will, but if some parts of the economy experience deflation, which is to say prices coming down, where would you expect that to happen?
The services sector is actually still on the upswing. Inflation, it's still accelerating. I would anticipate that would start turning around as we get into this slowdown and eventually a recession. That increase we've been seeing in the services sector will start coming down. So that will be part of the price structure that starts pulling the overall index down. In other words, now you're talking about price wars. Well, that's kind of getting into different components of the basket of things that make up the overall index, and so to focus too much on these relative price changes is it kind of can throw people off because that doesn't necessarily tell you what's going to happen to the overall index. It's just part of what's going on inside the basket. So we've got sectors right now. You talked about Walmart and some of these price war things that have been kind of coming through and on the headline. That's one thing. But the other thing going on right now is that services are actually going up. They're continuing to go up faster than the overall index. So some things in the index go down relative to other things that are going up. That's been a long time theme. We've talked about this even at the start of inflation. Remember back in 2000, don't get confused by relative prices. If you want to keep your eye on the overall index, keep your eye on it. But if you focus on one thing like oil, for example, you might get thrown off.
Well, let's take a look at the money supply. So the M2 change in the M2 actually is just above positive territory now. No doubt you've been following this. April's number from the St. Louis Fed, 0.59% annual percentage change. This is the first time since a long time ago, since 2022, that we've had a positive growth. As you know, it's been sloping negatively. Now it's reinverting upward. I'm just wondering whether or not this signals, I guess, a return for inflation at some point if this continues going up.
Well, I wouldn't say inflation because remember Hanke's golden growth rate for the money supply measured by M2. It's about 5 or 6%. Now that golden growth rate, David, is the rate that is consistent with the Fed hitting a 2% inflation target. So it's even this little piece of data that you have where we have a positive little number, it's still well below even the 5 to 6% growth rate that consistent with the 2% inflation target. So we got to keep our eye on the money supply. You're keeping your eye on it. Everybody should keep their eye on it. And then if you get a significant changes, if this goes up, for 6 months or so, and the number gets up above 5 or 6%, then we can talk about, oh yeah, maybe some inflation is going to be coming back in the system. But that will happen with a big lag, of maybe a year or 2 years after the change in the money supply.
Since 2 weeks ago, a bunch of central banks have been cutting rates. First, it was the Bank of Canada, than the ECB. This week, the Federal Reserve is meeting. What is the Fed going to do? Do you think the Fed is going to follow suit and cut rates this week, like the other
I,
central banks?
I think I think the Fed will sit on its hands.
Oh,
There's I think there's virtually no chance that they're going to change the rate this week.
right. Okay. Well, why is it
And
that the other
in
central
fact,
banks are
if,
more
if
willing? Sorry. Yeah, go ahead.
well, well, the other central banks have witnessed the same thing we have. Disinflation. The inflation's been coming down, and you mentioned Canada, the ECB for those two places. Inflation has been coming down, and the economies are showing quite a bit of weakness. Right in front of the windshield, they're showing weakness. In the United States, we have inflation coming down. That's fine, but we also have what looks like a strength in the economy. I think it's the economy's slowing, but it's certainly the headline picture is one. You just mentioned the employment numbers we got last week. They were much stronger than the consensus. So the picture is different in Canada and the eurozone. The Canadian economy is weaker than the U.S. and the eurozone certainly is weaker.
Okay. Well, I think the question on people's minds is how much longer do we have to wait for a Fed cut? I mean, yes, we're not at 2% inflation yet by core or headline metrics, but the trend of inflation has been downward, right? It's been disinflationary. So, how much more do we have to wait?
It looks like now, if you look at the Fed funds futures market, and that's the only objective way to get some prediction on what the market participants with skin in the game think is going to happen. We're going to have to wait surely until September, maybe even later.
Is there any chance they'll hike rates, Professor, if inflation remains, stubbornly above 3%?
Well, that doesn't look like that's in the cards. If you look at the Fed funds futures market, that doesn't look like it's in the cards.
Well, do you think they should hike rates to accelerate this
No,
disinflation?
no, 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 because monetary policy, number one, is not about interest rates. It's about changes in the money supply, and the money supply has been contracting, and even the little growth that we see year over year in the last monthly data, the growth is way below the 5 to 6% range that would be consistent with hitting a 2% inflation target. So my answer is no. I think they should in fact stop the quantitative tightening. They've said they're going to slow it down. They are slowing it down. I think they should stop it. I've been saying this for a long time. In other words, we've put this thing into context. What's all this gobbledygook we're talking about actually mean? And it means the following: we've only had 4 times since 1913, when the Fed was established, in which the money supply actually contracted. And what happened? In all 4 of those contractions, we had recessions. And by the way, the biggest contraction we had was 1929, 1933. You know what happened then? We had the Great Depression. But we have to go back to the late 40s and then go back into the 30s and then once late in the 1920s to even find these contractions. So what we're witnessing now is highly unusual. The contraction that we're facing is really something that's you don't see very often. I mean, we've only seen it 4 times, and to go back and find the last one, you have to go back to, I think, 1948, 1949. So it's a long time ago. This is unusual stuff, but what is usual is what follows a contraction, and that is a recession.
By the way, let's talk about this 2% inflation target. It's my understanding that Bernanke was the first in the US to officially state a 2% target, correct? I think other central banks. I actually spoke with Don Brash, who was the former governor of the New Zealand Reserve Bank. and he was the one that started it in 89. This is a clip of me asking him why the New Zealand Reserve Bank of New Zealand did it, and then other central banks followed. I just want to get a reaction to this. But this was the first of its kind in the world. Why? Why did New Zealand adopt a 0 to 2% target in 1989?
I think the answer relates to the fact that the government of the day wanted a different relationship between the government and central bank than had ever been tried elsewhere in the world. Prior to 1989, when the Reserve Bank of New Zealand Act that year was passed, there were two kinds of central banks in the world. They were the banks like the Federal Reserve Bank, the Swiss National Bank, the Bundesbank, completely independent of political direction, at least in theory. And on the other hand, there were the central banks, which really simply the agent of the Minister of Finance, agent of the government. And they did whatever the government required them to do. And the consequence of that framework was that politicians frequently used monetary policy to short-term political advantage. Now, the 1984 to 1990 Labour government, which was in theory a left-of-centre government, but actually in many respects the most right-wing government economically that any New Zealand that New Zealand's ever seen, said, look, that's not the right framework. The government should decide what inflation rate they want. It's an inherently political decision. How fast do we want our currency to devalue? But to say that, they have to specify that and in public, so the public knows what the government's inflation intentions are. And it almost requires a numerical target. Once you say the government should decide the inflation rate, central bank should be responsible for delivering the inflation rate, that requires some kind of specification of that target. And in our case, the target nominated by the Minister of Finance at the time was 0 to 2.
Well, actually, most people don't know. There is an economic theory. Knut Wicksell, the great Swedish economist, got this thing all worked out theoretically in the late 19th century. Most people don't know that. I know it because Lars Jonig, who I've written 3 books with, has a professor at Lund University in Sweden, has just finished a long paper in which he's dug out all this Wicksell work. And sure enough, Wicksell had the theory of inflation targeting worked out a long time ago. Most people don't know this. I mean, and they will pretty soon because Jonig's paper will be published in a good journal, no doubt. So that's the theory has been around for inflation targeting, and with an inflation target, New Zealand in the modern context and as you say with Don Brash, you interviewed him and ran his tape. The one pushing behind that was Sir Roger Douglas, who was the finance minister in New Zealand, a good friend, and in fact, I'm just publishing a paper, a 3-part paper that Sir Roger has written about the 2024 New Zealand budget. I'm literally we just corresponded over the weekend, and he had sent me this paper, and I'm publishing it ASAP, which I'll send along to you. But anyway, Douglas did something they called Rogernomics. So people can go to Wikipedia and see what Rogernomics is all about. And it's very similar to Reaganomics. It's liberalizing the economy. And the Labor government was the one that did this. And David Lange was elected prime minister, and Sir Roger was the finance minister, and they did a big batch of reforms that involved ultimately this inflation target thing that Don Brash was talking about. But at the time, it was a great bet. I was actually the president of a mutual fund in New Zealand as a result of that. Toronto Toronto Trust New Zealand, I was a president of it, and we took great advantage of the reforms that they made with Longay and Douglas at that time, which the New Zealand economy boomed, by the way. They liberalized the economy and boom, the New Zealand Kiwi got very strong and everything took off.
Yeah. Yeah, and I did ask him whether or not he thinks we should go back to targeting a money supply system, which I believe is what Paul Volcker did for this 2% inflation target, which became official, right? And this was just a different targeting system. But what is your view?
Well, they're two different things. One is to have an inflation target. Then two is, well, how do you hit the target? And the quantity, using the quantity theory of money and coming up with Hanke's golden growth rate figures for whatever the country happens to be. That's the way you do it. If you want to hit the inflation target, forget interest rates. You've got to look at the money supply and the quantity theory of money. MV equals PY. That's the identity. You solve for M in that MV equals PY equation, and bingo, you've got a Hanke's golden growth rate that's consistent with whatever the inflation target P is that you're putting in there, whatever the value is. I mean, different countries have different inflation targets. So the first step is to have an inflation target. The second thing is, what mechanism are you going to use to hit the target? And the only reliable one is the use of the quantity theory of money and the equation of exchange. MV equals PY. Solve for M.
Yeah. Do you think the target should be flexible, meaning sometimes it should be 3%, some years it should be 1%?
No. I think the target should be 0.
Really? Okay. Well, that's different from what I've been told. Well, yeah. Explain that, please.
Well, you can adjust the rate of growth in the money supply to hit any target you have. So why not have 0 as a target? Who wants to see their purchasing power whittled away over time, even at 2%?
Can you still get GDP growth with 0% inflation?
Of course. You just all you do is just notch the let's say let's go through the exercise.
Yeah.
Hanke's golden growth rate for the United States is, let's just say for purposes of our discussion here, it's about 6%. And that is consistent with hitting an inflation target of 2%. Now, what if we change the target to 0? What would we do for the golden growth rate? It would go from 6 to 4. That's it. You just slow down the rate of growth in the money supply, and nominal GDP will go up at 2% slower rate than if you had a 2% inflation target and you were growing the money supply at 6%.
It correct me if I'm wrong, but it just occurs to me that New Zealand was the first to do this, and then Don Brash said that the Bank of England called him, the Bank of Canada called him, and then they followed, and then the rest of the world followed. It just seems like, one bank started it, everyone else just started doing it because everyone's doing it.
Oh, yeah, right. Now, if you look, I'm not saying most. I haven't looked at, all 180 or 90 central banks, but most of them that I follow, even in odd countries like Zimbabwe, they have inflation targets. I mean, China has an inflation target. It's 3%.
So it really, depends on the economy. And you're saying for the U.S. it should be 0, but it's not 0.
Well, I my preferred inflation target would be 0, but it happens to be it's 2%, and we kind of gradually went into this in the United States. Before it became kind of the official target, it was kind of de facto. It was kind of in everybody's head, kind of informal, and as I say, de facto. But then it became more in stone, and that happens to be the target too. That's the most for most developed countries. Two is kind of the fashion, shall we say? Why not? Why not zero?
By the way, it's reported that a record $9.3 trillion of U.S. debt will be maturing within a year, Professor. Is this something that's going to be of concern to you?
Yeah.
Is this debt going
Well,
to? Yeah.
it's of concern because once it matures and they have to roll it over, they're going to be rolling it over at higher interest rates than the original issue, and so the interest charges that show up on the budget of the federal government will go up, and you're paying interest on government debt when you pay taxes that for nothing. I mean, you're just paying interest. So, it's we're talking about big numbers already. The number now, interest on the debt has already gone up. It's larger than the Defense Department budget. So it's we're talking about big bucks here. So it's a big deal. Taxpayers will be paying more and more of taxpayers' money will be going into simply paying interest on the debt, and that means by definition the taxpayers are getting nothing for that. And this idea, that we the debt isn't a burden because we so-called owe it to ourselves. That line, you've heard that line. You've probably seen it in economics principles books. It's completely rubbish because the debt always is paid for, and you either pay it, by the way, directly by, in this case, increased interest charges on the debt, but also you have another thing, a phantom tax, and that's inflation. That's another way it's financed. You finance debt two ways: with direct taxes and with inflation tax. So it is of a concern, and it is in another way, actually, and that is when you run deficits in a government budget, you're producing to the public really what I call a lying price, because you're spending, let's say, 100, but the price that you're actually charging at this time is let's say if the deficit's 20, the price would only be 80. Now it eventually gets paid back, but right now the price people face, it's a lying price. They're not being charged full freight on the amount the government's actually spending. The government's spending a lot, but taxes aren't covering the cost of that spending. So that's a lying price. The government's lying to the taxpayer because the taxpayer thinks he's getting a good deal at this time right now when the deficit is running, without realizing, of course, that somebody in the future is going to have to pay it back.
Okay, I want to address something else with you, which is the issue of de-dollarization. It seems to be that dollarization is kind of picking up. This is an article from the Financial Times. A net 18% of global central banks plan to increase their allocation to the dollar over the next 1 to 2 years in response to U.S. interest rates remaining high, according to the official Monetary and Financial Institutions Forum. Now, this seems to be a reversal of whatever trend we were experiencing before, right? What's your response to this?
My response to this is what I've been telling you all along. This doesn't surprise me. The central banks are piling into dollars because that 18%, that's a net number, by the way.
Yes.
That's net 18% are going in. So they're piling into the dollar big time. And the de-dollarization is a little bit of a tempest in a teacup kind of thing, because the international currency is the US dollar, the safe haven currency is the dollar, and there is always one, and always has been only one international currency. In the last 2,500 years, there have only been 14. So to knock the king off the throne, challengers have a lot of trouble. And to just show you the kind of trouble that are that people who want to knock them off the throne, China, for example. The Chinese yuan is only used on international transactions only about 3% of the time, and in nominal terms, the size of the economy in China is about 17% of global GDP. So it's the yuan is not used very much. And by the way, 80% of those so-called international transactions actually are just taking place in Hong Kong with the yuan. So I mean, it's basically not really used for all practical purposes internationally.
Yeah, this article says that. At the same time, demand for the renminbi has stalled among central banks, halting a trend of recent years where more central banks had aimed to add exposure to the Chinese currency. Now, is this political?
It is political. This gets down. Why do you see every day in the paper articles about de-dollarization? Everyone's de-dollarizing.
I ask myself that question every day.
Yeah. So the reason for this is the spin that is put on these stories. It's coming from the crypto crowd. The crypto evangelicals, of course, want to put it out. So everybody gets worried about the dollar and they go into crypto. So that's one faction. And the other is, for example, the BRICS countries, the enemies of the United States, China, okay, Russia, okay, Iran, okay, Brazil, everyone who's got it in for the United States, they like to trash the dollar. And they keep saying they're going to come up with something better than sliced bread, some new currency. It's not going to happen fast, believe me. Historically, if you look at the history, which I gave you a summary of, 14 international currencies in 20 over now since in the last 2,500 years. So they don't change very often. Something has to really go haywire with an international currency before it gets dethroned.
Maybe geopolitical tensions in Europe could cause this to go haywire. I don't know. I'm just speculating. Let's talk about Eastern Europe now. The war in Ukraine yeah.
Okay, but if things go, what happens? By the way, that's a good point. Let's assume things go very bad in Europe. They're already pretty bad, but assume that, let's assume generalized war breaks out. The safe haven currency is the U.S. dollar, and the dollar will get very strong then. If that happens, the reason the dollar has been so strong the last couple of years is because of its safe haven status and geopolitical tensions. We've got a war going on in the Middle East. The U.S. is in a proxy war with Russia right now in Ukraine. And what we always find, if there's a war that breaks out, we have a gradient from the war zone back to the United States, an increasing gradient with the U.S. dollar strengthening. The closer you are to the war, the weaker a currency is. The further away you get, the stronger it is. And the U.S. happens to be geographically pretty far away from the South China Sea. It's a long way away. From Taiwan, it's a long way away. From Ukraine, it's a long way away. From Gaza, it's a long way away. Those are all things that are safe haven positive for the United States. Plus, the United States has a huge liquid capital market that people can go into. And if you look at foreigners have been piling into U.S. corporate bonds big time, by the way, dollar-denominated bonds.
I've heard that de-dollarization argument from not just the crypto people, also from the gold people as well. I think the arguments here are kind of similar in the sense that one of them is, look, we've got Russian assets being frozen, about $300 billion worth of assets being frozen since 2022. Now the world sees this and is afraid that they're next, so they want to de-dollarize, get their assets outside the SWIFT system, and buy gold, buy Bitcoin. Right? That's the argument.
Well, yeah, that is the argument, and of course now gold. Speaking of gold, of course, the central banks, certainly China and Russia, are piling into gold.
Yes.
There is gold. Gold is attractive because it's not issued by any government. It's not the liability of a government. It's not the liability of a sovereign. So it doesn't. It has no national characteristic associated with it. It's not a U.S. liability or a Swiss liability. It's nobody's liability.
Right. Speaking of Ukraine, by the way, it was reported that early June, so last week, Ukraine actually did strike Russia using U.S. made missiles, striking the Belgorod region, the city of Belgorod, which is on the Ukraine border. The question is, what is Russia going to do in response? Putin has said that they would retaliate by sending weapons to quote unquote enemies of NATO. Who are these enemies of NATO, Professor Hanke? Who is officially an enemy of NATO right now?
Well, first of all, this cross-border thing has been going on. The Ukraine's been shooting into Russia along the border now, into Russian territory, for the last year.
They weren't allowed to do that, though, right?
Well, this is a joke. I'm telling you, they have been shooting into Russian territory for a year. This is what you're talking about. They finally have just started reporting it a little bit, the Western press.
All right.
But so it's been going on for a long time. Now, the issue is whether permission has been given by the U.S., who's been supplying these armaments, to go deeper into Russian territory. And that's where Putin has essentially said, we got some red lines, fellas. It's one thing to be shooting across the border, 100 or a few hundred miles into Russia. It's another thing to go more deeply into Russia, into more strategic radar sites and things like that. He said that's a red line, and that gets to your question. He said then he will react. So that would be if the West escalates and sends things deeper into Russia, Russia will respond. Putin's already said this, and things will escalate, and so we're in an extremely dangerous situation. We're the West and NATO are just playing with fire with this thing.
How will they escalate, Professor? How will the Russians escalate or retaliate?
We don't know. Do you think Putin is stupid enough to tell us exactly what he's going to do? I mean,
well, let's analyze what he has said. So he has said that he's going to send weapons to enemies of NATO. I don't know what that means. I think what this means is Russia is going to start supplying weapons to whoever America and its allies are fighting. I'm not really sure who those people are.
Okay, the weapons. I don't know. My guess is they're probably, if it's weapons, that's
right.
Basically friends of Russia, which I assume they're doing already, but that's something else.
All right. So
the escalation that's one that is an aspect that you're talking about. What I'm talking about is something different, and that is escalation in terms of attacks from Russia to potentially areas that are in NATO territory. That's basically what he's saying.
I don't. Can you please explain what what would they gain from doing that? I mean, what would be the incentive to hit NATO directly?
Well, the incentive would be that they've been hit, that they've been hit deep into Russia,
right?
And into radar sites and so forth that are positioned to defend Russia from intercontinental ballistic missiles.
Is this really an escalation, though? If what you're saying is true, that Ukraine's been doing this already for about a year,
Well,
and
no, we're
nothing's
talking about
changed.
different things. So we're talking about different things. So this is
Right.
all very nuanced, but if you sort through it, it's pretty clear.
Right.
Right now, for over a year, Ukraine has been sending missiles or drones or whatever the armaments are into Russian territory. This is not anything new. It's been kind of newly reported, shall we say, but it's been going on for some time. Now, the escalation would be if those attacks are more deeply into Russian territory, hitting strategic Russian targets deep in Russia. That's it. That's the escalation, and that's what Biden is essentially signed off on. This is what's going on.
They have long range. Yeah.
Biden and NATO are escalating this thing as we speak. And Putin has said, well, okay, you might end up getting a nice big black eye by doing that, because we're not going to stand by and have you sending shots into deep Russian territory, knocking out our strategic defenses.
You would think that Biden would not want to rock the boat shortly before an election, right? I mean, maybe there's something motivating him or his allies.
I mean, maybe not. Maybe he thinks it'd be a wonderful distraction to get in a third world war.
Okay. Well, let's hopefully that doesn't get to that. I don't think anyone wins from that scenario, but okay. So we don't know what
if they're shooting off a few of these things going deep into Russia, that would be a massive distraction before the election.
Well, Ukraine now has supposedly long-range missiles with a range of up to 500 kilometers. That puts it within reach of Moscow if you place those missiles to the nearest city to Russia, to the east, northeast, right? I mean, would they do that?
Well,
Would we see that happen?
Well, Biden said Russia is kind of we don't know. Number one, we don't know, but
Right.
Biden has specifically said not Moscow.
Well, he did also say,
But he's this thing is on an escalation treadmill. The Ukrainians are losing very badly in the war. That means the U.S. is losing badly, because this is just a proxy war with the U.S. and NATO. I mean, the U.S. runs NATO, the U.S. runs a show, and the U.S. is in a proxy war with Russia, and they're losing very badly now. So as a result of that, that's why all these announcements and so forth are coming, and that's why the escalation is in the wind. That's what's going on. The U.S. is losing.
well, that was my final question, whether or not the U.S. can afford to continue funding this war in Ukraine. Well, I think the assumption is the budget deficit could widen without any recourse, right?
I think if you look at the election that this took place in Europe over the weekend, I think the European voters said they're fed up with all this spending of money, among other things. But the war in Ukraine and the financial drain that's been taking on these European countries, the voters went to the polls and they deep sixed all the leadership. All the warmongers in Europe got slammed big time this weekend, including, of course, the big one, Macron in France is actually called a snap election. He got clobbered so badly in the election over the weekend. But the German chancellor got totally wiped out in the election too. So these are the big warmongers in Europe, and the voting public said, we're not too keen on war. We want you out. So maybe that's
Do you think
coming back to the U.S. Maybe that would be the the way the U.S. voters would turn on the thing.
Well, yeah, speaking of U.S. voters, do you think the voters, the people in America, would support putting American troops in Ukraine? Not on an advisory basis, but combat troops on the front lines.
I think this would be a big negative. We've already got troops there, by the way. This is a little bit of a fiction that we don't have troops in Ukraine. We do have troops in Ukraine, and all the targeting of all these spots in Russia on Russian territory, that's all done by the United States. That's all done by U.S. AWACS and U.S. military equipment, NATO equipment, and so forth. That the Ukrainians they don't have the capacity to do this. So that's why I say it's a proxy war going on, and a lot of this is just fictional. Now, what you're talking about is some Marine with a machine gun and a machine gun nest on the border of Russia shooting at Russians. Now, I don't think the American public would be too keen on that. We did that in Vietnam. That didn't turn out very well.
All right, more to discuss there. Thank you very much for your updates. We'll speak again soon.
Okay, great.
Appreciate it. Thank you for where can we let the viewers know where we can follow you? Your Twitter.
Okay,
right?
Yeah. If Twitter is a easy place,
Yeah.
And that at Steve _Hanke Hanke, or you can always write me if you want me to put you on my distribution list, and just send me an email at Hanke Hanke at jhu.edu.
Okay, we'll put the links down below. And I almost forgot to mention that if you're watching this right now, please do email either Professor Hanke, the email that was just given, or myself for questions for our next episode together, which will be in about 2 weeks from now. Great. Thank you very much. We'll speak again soon, Professor, and thank you for watching. Don't forget to like and subscribe.